Hello class, this is Brian from FinancialTrainingSchool.com and welcome to GT402 Persistence. And just before we start, I'm just going to say right off the bat, I hope you guys enjoyed this video because I spent about 6 hours coming up with the PowerPoint for this video. This went through about 10 different revisions. Initially, it only had about 2 or 3 slides for the 200 series, and then changed it to add more details to it to put it in the 300 series, and then finally we ended off with about 6 slides, and it's now in the 400 series. So continuing my story from GT205, Time and Effort, if you'll recall, I started my first business in 2007, and although each year I managed to turn a profit, I profited the most during the first 3 years. So during 2007, 2008, 2009, I profited the most, and then after that it started to drop off, which is why I diversified into other assets. So part of those profits was the foundation of my starting capital when I started stocks in March 2010. Within the first month of trading stocks, I lost about 75% of my initial capital, since I started in penny stocks instead of blue chip stocks. Luckily, I managed to recover and I profited during the summer of 2010 and the winter of 2011. Some of the profits from summer 2010 were put into binary options, which I started initially in October 2010. By about January 2011, I had profited from binary options, but soon after, I lost about 25% of my profits over the course of the next couple months, but I eventually got it back. Then I used some of the profits there to start trading Forex in May 2011. And within the first 2 weeks of trading Forex, I lost about 33% of my account as well. Finally, by October 2011, I profited from Forex as well. Lastly, although I didn't trade much this year, 2012, I currently still have a small overall net gain in binary options and stocks. So I'm still profitable to this day. The moral of my story and this lesson is persistence, and this is regardless of making profits or not. And there are 2 factors to consider here: time and money. Fortunately for me, I'm a quick learner and I was motivated to keep going, and eventually I ended up profiting. But as you saw, I didn't have a perfect story. Nothing went according to plan from day one. I had my initial mistakes and losses, but eventually I learned from them and I kept pushing onwards. You can't learn from mistakes if you don't make them. And this is a reference to GT201, Phases of Trading. In that lesson, I outlined that you have to learn, apply, relearn, reapply, and repeat until you master the concept of whatever it is that you're trading. As I taught in the psychological lessons in the GT200 series, you have to be emotionless, motivated, treat trading as a business, and so on to be able to make it. Because if trading was easy, 99% of traders wouldn't be losing money. So don't be so quick to give up. I would say the minimum time that you should spend trying to figure out how to trade an asset is a year, at least. Minimum. I've received emails in the past from people who tried to trade for a couple weeks up to a month, then give up. That's kind of stupid because anything less than a quarter, e.g. 3 months, is insignificant for multiple reasons. A stock position can last up to multiple years. So if the time frame is a few years, a couple weeks means nothing. If you lost money, it just means you picked a bad stock to invest in, and that's your own fault due to not researching enough. Compared to a Forex trade, depending on the time of year, it can be fast or slow. For example, during news release or elections, it can be fast. Or during the summer or winter holidays, it can be slow. So if you're losing or not making anything significant, it could just be a wrong time period that you're trading during the year. And the reason why I say a minimum of a year is because it gives you the chance to trade every possible time frame or time period in a year. To take it a step further, I would say 2 years to be safe. First year is to observe everything in the market so that you observe every month of the year, and then the second year is to confirm what you observed during the first year so that you can apply it in the third year. So 2 years would be a safe buffer zone, but minimum a year before you give it a second thought. Also, losing money isn't a reason to quit or move on. In terms of money, since you're a new trader, why would you throw your life savings into something you're not sure about or still learning? You need some trial money just to test out things. So everyone should have some startup capital to risk. As I outlined in previous lessons, the initial amount can be thought of as your tuition fee. So what are you willing to pay to learn how to trade? Also taught previously, you should only be trading with money that you can afford to lose. Thus, your tuition fee shouldn't cause a financial burden for you. However, in the worst case scenario where you've already lost too much by throwing your life savings away, or your financial situation has changed, you can no longer risk money to trade with, then I suggest you just quit or take a temporary break. And this is referencing GT211 coping strategies, which I outline what happens if you lose and what do you do to cope with the stress. So don't even bother switching financial instruments, because most of the time it's a time and effort factor, not a money factor. So like I said, switching financial instruments is not the solution. Referencing back to my story, I didn't switch immediately after my losses. I continued with my asset choice until I profited, and then I switched afterwards. And this is a business concept, since you're supposed to treat trading as a business anyways. Each individual instrument can be viewed as a separate business. If a business is performing well, you take the profits from that business to reinvest in itself, referencing GT402 patients, compounding profits to let your profits grow within the account, or you invest the profits into a new business, e.g. a financial instrument in this case. Compared to businesses that are losing money, if you think about it, those businesses don't close down immediately. They already invested their money, so they're going to stick through it to see if they can turn a profit. Most companies who do fail do so after a few years, not a few weeks. So there's no reason for you to jump ship so fast. Lastly, to end off this video, as you'll recall in GT303 diversification, I outlined in that video that it would be in your best interest to split your portfolio into short-term and long-term assets. Trading two different assets simultaneously is not a form of giving up, because you're still actively trading both of them. But when do you decide to move on to the second asset? My suggestion would be you should start your trading career knowing that you'll eventually split your portfolio into two assets, but in the beginning, focus all of your time to learn the asset that will contain most of your capital. Then, once you've got that started, quote unquote, you can learn the second one while maintaining the first one. So that's the route I would suggest you go. Don't try to learn both of them at the same time. Focus on the one that has most of your money in it, and then once that one's settled, then move on to the second one while maintaining the first one. A suggestion to make this easier would be to pick assets that complement each other. So stocks inherently is geared towards longer term trading, and is usually complemented with vanilla options, because in vanilla options is like the insurance. Same thing with Forex, which is geared towards shorter term trading, and it's usually complemented with futures or binary options, which is a subset of options. So that concludes this lesson. Hope you guys enjoyed it, and I will see you guys next time.